Hey everyone, welcome back to Corporate Decoder. Today, Sentinel Holdings Ltd SNTL just filed its first quarter 2026 report, and I am seeing a lot of red flags and some very confusing moves. Quick note, this is not financial advice, just my take on public filings for educational purposes. This company is really struggling to turn a profit, and some of their recent transactions make me wonder about their strategy. Let us dive into the balance sheet. As of the 31st of March 2026, the company had total assets of just over $2.3 million. That sounds small, but when you look at their liabilities, they owe over $4.7 million. That means they have a negative net worth, or what they call a stockholders deficit, of over $2.4 million. This is pretty straightforward, meaning they owe way more than they own right now. Now let us look at how they are doing in terms of making money. For the first 3 months of 2026, they brought in revenue of about $2.2 million. That sounds good, but their cost to actually make that revenue was over $2.1 million. That leaves them with a tiny gross profit of just over $122,000. That is a profit margin of only about 5%. Not great, especially when you consider their operating expenses. They spent nearly $1 million on general and administrative expenses. That is a huge number compared to their small gross profit. This led to a massive operating loss of over $874,000 in just 3 months. The really crucial number, the net income available to common shareholders, shows they actually made a small profit of about $53,000. This small profit comes from some unusual income, not from their actual business operations. This profit is largely thanks to a gain on an acquisition of nearly $1 million. It seems they made money not from selling security services, but from buying and selling parts of businesses. Looking at cash flow, the company used about $155,000 in operating activities. This means even with that gain on acquisition, their core business is not generating enough cash to cover its expenses. Now let's talk about some of the transactions mentioned. In October 2025, they acquired the operating assets of Opsec Specialized Protection, Inc. for $800,000. They recorded a gain on this acquisition because the value they assigned to the acquired contracts was more than what they paid. This is a bit of a red flag because it suggests they might be overvaluing what they bought or getting a bargain price that sounds too good to be true. Then in February 2026, they sold their USS subsidiary. This sale generated a gain of almost $1 million. While selling off a part of the business can be a strategic move, it also shows a pattern of buying and selling assets as the main way to show profits, rather than growing their core services. Let's look at their liabilities again. Accounts payable and accrued expenses are over $3.8 million. This is a significant amount and signifies money owed to suppliers and for other short-term obligations. They also have $35,000 in convertible notes. These are loans that can be turned into stock. This is often a sign that a company is struggling to raise cash through traditional means and might be diluting existing shareholders down the road. Then there are derivative liabilities worth over $353,000. These are complex financial instruments whose value changes based on other underlying assets. It is a sign of financial complexity that is often associated with companies trying to manage risk or in financial distress. As we saw earlier, their total stockholders' equity is a deficit of over $2.4 million. This means shareholders have lost more than they invested. They have series of preferred stock where 2 million shares are issued and 75,000 shares of Series B preferred stock. 9.6 million shares of common stock are outstanding. They have over $21 million in additional paid-in capital. This is money investors paid for stock above its par value, and an accumulated deficit of nearly $24 million. This is the total net loss the company has incurred since its inception. There is a negative non-controlling interest of over $379,000. This usually means there are minority owners of subsidiaries who are losing money and not in favor of the main company. The statement of changes in stockholders' deficit shows $350,000 from warrants issued for cash for the first 3 months of 2026. This means they sold warrants, which are like options to buy stock later, to raise some cash. Looking at financing activities, in October 2025, the company issued 10,000 shares of preferred stock Series B to its president and CEO Kyle Magej, valued at $500,000. This is a large stock compensation for services related to an acquisition. While it is common for executives to be compensated with stock, the valuation of $50. per share for preferred stock that can be converted into 50 common shares. When common stock was recently valued at $1 per share in cash offerings, seems quite high. This might be a way to grant significant executive compensation. In their business reassessment and repositioning for the year ending the 31st of December 2025, they recorded a benefit of over $2.2 million. This came from writing off nearly $2.1 million in payroll and payroll tax liabilities that they deemed unnecessary. This is a very unusual adjustment, and it raises questions about their past financial management and how these liabilities were allowed to accumulate and then suddenly be dismissed. It is like finding money under your couch cushions after a long time. On the tax side, Sentinel Holdings has significant net operating loss carryforwards, or NOLs, of about $7 million. This means they have experienced so many losses that they can use these past losses to reduce future taxable income. However, a full valuation allowance is recorded against these deferred tax assets, meaning they do not expect to realize their value. This is generally a sign of persistent unprofitability. Now, for the legal fireworks, there are several ongoing lawsuits. One notable case is James Maritime Holdings, Inc. versus Matthew Matazzo. This involves alleged breaches of fiduciary duties and claims that former management took out loans without approval. Sentinel Holdings is trying to claw back shares issued to Matazzo and others. This sounds like a messy internal dispute, possibly stemming from past management issues. Another case is Virtual LLC versus Gladiator Solutions. This is an arbitration claim where Sentinel Holdings was notified for the first time about an arbitration award against Gladiator Solutions for over $332,000. The fact that they were blindsided by this arbitration and award is quite concerning and points to significant control and communication issues within the company. There is also a suit by Eardley, the former CEO, claiming shares issued to him were not authorized. Sentinel Holdings has counterclaimed for fraud and breach of duty. This is another indication of internal turmoil and potential financial misconduct from past leadership. Finally, a civil action against Mr. Rajan and his entities for damages arising from a campaign of character assassination and economic sabotage. This sounds like a very aggressive and damaging dispute. When we look at their internal controls, management themselves stated that their disclosure controls and procedures were not effective. They identified material weaknesses. This means there are serious flaws in their internal financial reporting. These include challenges with segregation of duties due to a small team, failure to identify journal entries and reclassifications, and a need for more technical accounting expertise. They say they intend to fix these issues as resources become available. But this is a significant concern for investors as it suggests a lack of reliable financial oversight. Looking at unregistered sales of equity securities, the company has been quite active in selling shares and warrants. For instance, in February 2026, they sold 350,000 warrant units for $350,000. They also issued preferred stock and common stock for services and cash throughout 2024 and 2025. This constant selling of equity suggests they are heavily reliant on external funding to stay afloat. The fact that some of these were issuances of preferred stock to executives and related parties at what seem like high valuations further raises questions about fairness and dilution. And here is a big one. Padang Ltd owns a significant chunk of Sentinel Holdings, specifically 2 million shares of Series A preferred stock and 50,000 shares of Series B preferred stock. On a fully diluted and converted basis, this gives them 80% of the company's voting power. This means Padang controls the company, and they have the power to make all major decisions, including electing directors. This level of control by one entity can create conflicts of interest. Analysis. So, what is the story here? Sentinel Holdings is a company operating in the security services industry. However, their financial statements paint a picture of a business struggling financially. They have consistently reported losses, accumulated a large deficit, and are heavily reliant on external financing through stock and warrant sales. The significant gains reported are not coming from operational improvements but from acquisitions and asset sales, which is not a sustainable long-term strategy. The numerous lawsuits and material weaknesses in internal controls add to the concerns about the company's stability and management's ability to execute effectively. The substantial control by a related party, Padang Ltd, also introduces potential conflicts of interest compared to other struggling micro-cap companies that rely on asset sales and complex financial instruments to show profits. Sentinel Holdings faces a steep uphill battle. The biggest concern I am watching is the company's ability to generate consistent, profitable revenue from its core security services business, rather than relying on one-off gains from transactions. Their path to profitability seems very unclear, and the constant need for capital suggests they are burning through cash at an alarming rate. What I am actually looking for is a clear strategy and consistent execution in their actual business operations, which is currently lacking. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. Alright, that is my take. Stay decoded. If you found value in this analysis, please hit that like button, subscribe for more deep dives, and join our Discord community linked in the description.